Okay, we are now on our part 3 of module 2, which is a definitions of cash. So cash includes money and other negotiable instrument that is payable in money and acceptance by the bank for deposits and immediate credit. It includes cash on hand, a demand deposit or what we call the checking account, and other items that are unrestricted for use in the current operation. So the cash on hand awaiting for deposits are undeposited cash collections, the traveler's checks, cashier, official, treasurer's, managers checks, postal money orders, bank draft, or a written promise, written order addressed to the bank to pay an amount of money to the order of the maker. So what is cash in bank? A current account, checking account, demand deposits, or commercial account. Generally a non-interest bearing, withdrawable by checks against banks. Savings deposit or savings accounts, generally a non-interest bearing also. Depositor is issued an ATM card or a passbook. Withdrawable in ATM station or within the bank. Then cash funds or for current operations. So you have the change funds, the payroll fund, the purchasing fund, revolving fund, interest fund, petty cash fund, dividends fund, and travelers fund, and tax fund. These have been discussed in your part 1 accounting. Fund for non-current operations are part of the non-current assets and should not be included as part of cash. Examples are pension fund, generally non-current investment, but if related liability is current, the fund is included as cash. Preferred redemption fund, a non-current investment unless the preferred shares has a mandatory redemption and if redeemable within 1 year from the reposting period part of the current investment, within 3 months from the reporting period investment of current investment. Acquisitions of property, plant and equipment, always non-current even if expected to be disbursed next year. Then contingent fund, a non-current investment, insurance fund, a non-current investment, sinking fund, a non-current investment. If the related bonds payable is current, the fund should be included as cash. Note, classification of cash funds are current or non-current should be parallel to the classification applied to the related liability. Thus, an entity should reclassify such non-current asset if the related liability becomes current. Then cash equivalents are short-term and highly liquid investment that are readily convertible into cash and so near their maturity that they represent insignificant risk of changes in the value because of the changes in interest rate. May be qualified cash equivalents included the following: the time deposits, money market instrument or commercial paper, treasury bills or treasury notes or treasury bonds, redeemable preference share with mandatory redemption period. The treatment from those given: originally invested, acquired for more than 3 months before maturity date. So the remaining term in 3 months or less from the reporting period, we got a short-term investment. The remaining term is more than 3 months but within 1 year, short-term investment. The remaining term is more than 1 year, it should be a long-term investment. Originally invested, acquired for 3 months or less before maturity date, that are considered to be cash equivalents. Note, if an item cannot be included as cash equivalent because it did not qualify the cut-off time period 3 months, it will always be classified as investment. short-term or long-term, depending upon the period of maturity. The reckoning period for time deposit is its duration, since time deposit generally does not have secondary market. For other securities with secondary market, the reckoning period would 3 months from acquisition date until maturity date. If the problem is silent with regards to treasury notes and bonds, assume it is non-current investment. Cash money, market account, cash and cash equivalent. Time deposit, cash and cash equivalent. If in the problem, the distinction is silent. Some measurement issues and frequent encountered tricks in cash and cash equivalent computation. For cash measured at face value, cash in foreign currency should be translated to Philippine peso during the closing rate or spot rate at reporting date. Deposit in foreign bank and restricted part of cash. Restricted if material classified separately among non-current assets as receivables. Cash in closed banks, banks in bankruptcy, measured at estimated realizable value and included among non-current asset if the amount recoverable is lower than the face value. The bank overdraft, negative balance in the cash in bank account. Treatment if the company is in maintaining 2 accounts, different banks. Current liability may be netted against other bank if immaterial. Netted against other account if the part of the cash management PSA 7. Same bank may be netted against the account with positive account but cannot be offset against restricted account. Compensating balance. This is a minimum checking account balance that must be maintained in connection with the borrowing agreement with the bank. Treatment not legally restricted, it should be part of the cash. If it is legally restricted, if the related loan is short-term, cash as compensating balance is current receivable. Long-term, cash held as compensating balance is non-current receivable. Note that if the problem is silent and with regards to the compensating balance, it is assumed not legally restricted. So if there is no specification or the particular restriction, then it will be assumed as part of cash. Effect of compensating balance on yield rate increases. Effective rate increases. Effective rate is equal to net interest expense over the net proceeds. Undelivered unreleased check reverted back to cash by the account. So you have to debit the cash and you have to credit the payables. So any undelivered checks, then it will be reverted. Still checks or checks long outstanding. Checks not in cash by the payer within a related long period of time. Under current banking practice, checks are considered still if not in cash within 6 months from its date. The treatment would be still checks are reverted to cash by a debiting to cash and crediting to accounts payable if material, if not material, miscellaneous income. Post-dated checks. Checks are dated after the reporting date. Treatment, the company owned PDC and reverted to cash, debit to cash, and accounts payable. A customer's checks will still remain as receivable. IOUs included as part of receivable. Equity securities generally cannot be classified as cash equivalent because equity securities do not have a maturity date, with the exceptions of redeemable preference share. So, redeemable preference shares with a specified redemption date acquired 3 months before redemption date cash equivalent. Acquired for more than 3 months before redemption date current investment. Callable preference share not classified as cash equivalent. It is part of the shareholder's equity on the part of the user and part of the long-term investment of the holder. NSF, then we have the no sufficient funds, drawn against uncleared deposits, and drawn against insufficient funds. What are the treatment? Reverted back to part of the receivable. Expense advances and travel advances. So receivable or prepaid expense. Temporary investment in shares of stocks, either but never to included as part of cash and cash equivalent. Then unused credit line, difference between the amount of line of credit applied for approved by the bank and the amount actually borrowed. Treatment disclosed in the notes. Treasury warrants for payment of money into or from public treasury. Treatment included as part of cash. Escrow. So restricted amount held in trust for another party. Example, deposit required by an account of law for a pending case. Treatment, part of other current or non-current asset and reported as liability. Unrecorded disbursement. The record dispersed by debit to accounts payable or other appropriate account and credit to cash. And then we have unrecorded cash, the collections, receipts. You have to record by debiting the cash and accounts receivable or other appropriate account. The certificate of deposit for time. So, savings certificate entitling the bearer to receive interest, a certificate of deposit bears a maturity date, a specified fixed interest rate, and can be issued for any denomination. The CDs are generally range from 1 month to 5 years. Treatment. Invested 3 months before maturity, cash equivalent. Invested for more than 3 months, investment short term. Should be reported. Postage stamps on hand, bank overdraft needed from each cash are reported as office supplies or as prepaid expense. Bank overdraft that was needed or deduction from cash in the bank but should be presented as current liability and should be added back to compute the correct balance of cash in the future. So we go now to the petty cash fund. Empress system, a system that control of cash, which requires that all cash received should be deposited intact and all cash disbursement should be made by means of check. However, impractical for a company to make all payments through check. Therefore, a petty cash established to cover small and miscellaneous expenditures. Petty cash fund may be according to the using of the following methods. We have the Empress fund, we have the fluctuating fund. We got now the comparison of journal entries for Empress and fluctuating. In establishment of the fund, you have the debit petty cash fund and cash on hand. It's the same as in fluctuating. In payment of expenses, memo entry at the petty cash journal. In the fluctuating, you have to debit expenses, you have to credit petty cash fund. Replenishment of petty cash fund, we have debit expenses and then cash in bank. For the other, fluctuating, we have petty cash fund and then cash in bank. To establish the unreplenished expenses, you have to debit expenses and petty cash fund, but for fluctuating, there is no adjusting entry. For increasing the fund, it's the same. For a decrease of the fund, it is also the same. So the cash over and short account is used as a plug for miscellaneous expense or miscellaneous revenue when the petty cash fund fails to turn out to be satisfactory. Replenishment of check is the amount to be indicated in the replenishment check will be the total expense plus cash shortage unless the cash overage. It can also be determined by subtracting the bills and coins from the petty cash accountability. The petty cash fund count sheet basically four parts of the follows: accounting for petty cash items, accountabilities, petty cash cashiers acknowledgement, and auditors adjusting entry. Accounting for petty cash items inclusive of the impurities are accounted in the working paper, as the presence of the impurities may indicate some weaknesses in the accounting control system. A summary of the weaknesses in the accounting control system is prepared and submitted to the management after the general audit of the accounting records. The petty cash impurities are items which do not belong to the fund, but for one reason or another are nevertheless found in the petty cash box. Example of petty cash impurities are bills and coins and customer checks from the cashier's collection. This should have been in the general cash. Checks issued by the client in payment of utility bills, those have been delivered to the payees. Checks issued to the client in payment of personal advances, this should have been in the general cash. So, accountabilities in the account sheets consist the following: the cash fund balance per ledger, petty cash impurities except checks issued to the client in settlement of cash advance from the petty cash fund. Computation of petty cash shortages, cash accounted, petty cash accountabilities, overage or shortage. Computation of petty cash accounted and petty cash accountability. The petty cash accounted is coins and currencies. Petty cash accountability is PC fund ledger balance. Expended employee contribution. So, example, contribution for party, Christmas party and birthday parties. The petty cash impurities except checks issued in settlement of cash advance from the petty cash fund. Cash collections of account receivable on sale. Unexpected employee contribution for Christmas party and other parties. Unclaimed salary, collection of accounts receivable or sales, cash in check, checks for deposit, unclaimed salaries, steel check, post-dated checks. Then we have unreplenished vouchers, expenses for IOUs that are taken from the PC fund. Note, for unexpected employee contribution, unclaimed salary and cash collections of accounts receivable or sales, this should be included in the account accounted only when it is intact or in the envelope is not still closed or the cash count date. However, it is included as part of cash accountabilities whether intact or not. Example of checks. We have the employee's check, good, NSF or PDC, in settlement of cash advance from the petty cash fund. Checks of the company as replenishment of petty cash funds, and checks of the company payable to petty cash custodian represented by his or her salary. Employees' checks or checks issued to clients in settlement of a cash advance from the petty cash funds are not treated as accountabilities in the count sheet, as they simply serve as evidence that there were cash advances drawn from the petty cash fund. These are accommodated checks or checks cash out from the fraud. If the problem is silent, checks in which the payee is to pay to cash is assumed to be an accommodated check. Example of checks deposits that are part of the petty cash impurities, and if included in the petty cash accounted, must be included also in petty cash accountabilities. Example are customer checks. These are checks in the name of the client company and the maker is a customer. This represents collections of accounts receivable from the customer. Company's check in payment of liabilities. such as utilities. Cash collections and accounts receivable or sale. Cash collections or accounts receivable or sales may be evidenced by sales invoice or official receipts that are included in the petty cash pass. So, computation of adjusted petty cash balance, the coins and currency, you have to add expenses paid out, checks of the company in the name of petty cash custodian, replenishment of check of the petty cash fund or salary of the petty cash custodian, employees check, and we got now the adjusted petty cash fund balance. So this is now the formula in computing the petty cash fund balance. A bank reconciliation is a schedule prepared that accounts for the differences between cash balance per book and per bank statement. It is prepared only for checking accounts or demand deposit, and is prepared monthly because the bank provides a depositor with a bank statement at the beginning, normally first week of the following month. The forms of bank reconciliation are maybe adjusted balance method, book to bank method, or bank to book. Reconciling items are reconciling items are credit memos and debit memos and errors. So these are transactions by the bank which are not recorded in the book account. And the bank reconciling item are deposit in transit or outstanding checks and error. These are book transactions which are not been recorded by the bank. Deposit in transit, these deposits already recorded in the cash books in one period but were taken up by the bank only in the next period. Example, collection already forwarded to the bank for deposit but too late to appear in the bank statement. Undeposit collection awaiting delivery to the bank for deposits. The outstanding checks, these are checks written and released to pay and are already recorded in the cash books but are not yet presented for cash encashment of deposit in transit. Certified checks, these are checks that the bank already certified as having sufficient balance or funds, thus technically there are no longer outstanding checks. A debit memo, these are charges and deductions made by the bank to the account of the entity but not yet recorded by the entity. Example are bank service charge, NSF check, we have the payments of the loan, the final withholding tax on interest. A credit memo by the bank, these collections or deposits made by the bank to the account of the company but not yet recorded by the entity. Examples are collection made by the bank in behalf of the entity, proceeds of bank loan credited in the account of entity, the matured time deposit, and interest income credited to the account. This debit memo and credit memo are reconciling of the book, in which these have been recorded by the bank but not yet recorded by the book. Bank or depositors or book errors. Errors made by the company or bank that must be corrected by the reconciling to the balance. Following rules for errors assuming the company is using adjusted balance method of presenting bank reconciliation. Effect of the errors and treatment. The understatement of cash receipts add to an adjusted cash in the bank balance. Overstatement of cash receipts deduct from the unadjusted cash in the bank. Understatement of cash disbursement deduct from the unadjusted cash in bank balance. An overstatement of cash disbursement add on the unadjusted in bank balance. Guidelines in bank reconciliation and proof of cash. The bank reconciliation performed only after the company receives the bank statement in the next month. Example, the bank statement for the month for January is received in February. Thus, bank reconciliation of January will be prepared in February. Hence, unless otherwise stated, book reconciling items for January is assumed to be recorded in February after preparing the bank report. The following assumptions should be observed. A credit memo for January is assumed to have been debited. You are increasing the cash receipts in February. A debit memo for January is assumed to have been credited, increasing disbursement in February. Overstatement and book receipts in January assumed to be recorded by credit, increase in disbursement in February. Understatement in the book receipts, January is assumed to be recorded by debit, increasing receipts in February. Overstatement in book is disbursement, January is assumed to be recorded by credit, increase in receipts in February. Understatement in book disbursement, and January is assumed to be recorded in credit in February. From the point of view of the bank, it will only record the transaction upon actual receipts of deposits and upon receipts of for check payment or deposit. Unless otherwise stated, bank errors are assumed to be recorded in the next following month it committed the error. Therefore, the following should be observed. You observe the deposit at the end of January is assumed to have been credited. Outstanding checks at the end of January is assumed to have been debited. Overstatement in the bank receipts, you have to assume that to be recorded debit at this increase in disbursement in February. Understatement of bank receipt assumed to be increase in receipts in February. An overstatement in bank disbursement is assumed an increase in receipts in February. Understatement in bank disbursement in January is assumed to be recorded by increased disbursement in February. The proof of cash, to-date bank reconciliation. This is now the formula. Deposit in transit beginning, you have to add deposit made or granted this month, total deposit to be acknowledged by the bank, and then less your deposit acknowledged by the bank this month, deposit in transit at the end. And computing outstanding checks beginning, add checks issued by the company this month. It is a total checks to be paid by the bank, less checks paid by the bank this month, and we got now the outstanding checks at the end. This is now the formula in finding out the deposit in transit at the end and outstanding checks at the end. Computation the deposit by the company and the deposit acknowledged by the bank. We got book receipts less credit memo, book errors corrected this month, understatement, overstatement, book errors this month, and you have to add understatement of credit memo and the deposit made by the company this month. And the other one, bank receipts less credit memo this month, bank errors last month, corrected this month, understatement, our statement, and bank errors this month. You have to add understatement of credit memo, deposit acknowledgement by the bank. Computation of check issued by the company and the checks paid by the bank. We have book disbursement, you have to less a debit memo last month or book errors last month, corrected this month, overstatement, understatement, book errors this month, overstatement, understatement, and that is now the checks issued by the company this month. Bank disbursement, debit, less debit memo this month, bank errors corrected this month, overstatement, understatement, and bank error this month, overstatement, understatement. We got now the check paid by the bank this month. So those are now the formula. So deposit in transit should include customer post-dated check. If this were included and recorded as receipts for the month, the following treatment will be required in the proof of cash or bank reconciliation, assuming the adjusted balance method is to be used. So we start with an adjusted book balance, and then we have outstanding checks included in the following. We have the post-dated check, unreleased, undelivered company's check. And then, we have also now, we got the summary treatment of proof of cash, adjusted balance method, cash in bank card books, receipts, and then credit memo. So beginning, add receipts minus credit memo. You have to add in the receipts, you have to add in the ending. Debit memo, we have to minus at the beginning, we have to minus in the disbursement. A debit memo this month, you have to add disbursement and minus in ending balance. And we got now the adjusted balance of cash. Note, ending balance is equal to beginning balance plus receipts minus disbursement. Credit memo last month was added to the beginning balance because the receipts last month were understated, resulting to the understatement of the beginning balance. Also, the book receipts during the current month were overstated, brought about the addition of credit memo last month, and this credit memo last month was deducted from the book receipt this month. The book receipts for the current month and cash ending balance were understated because the credit memo this month was not yet recorded. Thus, in the proof of cash presentation this month was added both the book receipts and ending balance. So this is the explanation of the formula in the previous slides. A debit memo last month was deducted from the beginning cash balance because disbursement last month were understated, resulting to overstatement of the beginning balance. Also, the book is disbursement during the current months were overstated, brought about by the additions of this one. Thus, the amount was deducted from the book disbursement this month. The book disbursement for the current month was understated, while the cash ending balance was overstated because the debit memo this month was not added to the book disbursement. Thus, in the proof of cash presentation, this amount was added to the book disbursement and deducted from ending balance. So, this is now the full summary in the adjusted balance method in proof of cash. So, deposit in transit, outstanding check. The note, ending cash balance is equal to the beginning plus receipts minus disbursement. This is how to compute. Deposit in transit last month was added to the beginning balance because the receipts last month were understated, resulting to the understatement of the beginning balance. Also, the bank receipts during the current month were overstated, brought about the addition of this deposit in transit last month. Thus, deposit in transit last month was deducted from the bank receipt this month. The bank receipts for the current month and the cash ending balance were understated because the deposit in transit this month was not yet recorded. Thus, in the proof of cash presentation, this amount was added both to the bank receipts and ending cash balance. The outstanding check last month was deducted from the beginning cash balance because the disbursement last month were understated, resulting to overstatement of the beginning balance. Also, the bank disbursement during the current month were overstated, brought by the additions of this month. Thus, this amount was deducted from the bank disbursement this month. The bank disbursement for the current month was understated while the cash ending balance was overstated. While the cash ending balance was overstated because the debit memo this month was not yet recorded. Thus, in the proof of cash presentation this month was added to the bank disbursement and deducted from the ending balance. This is now the explanation of what is the summary of the proof of cash. Errors. both on books and banks. The amount to be presented here is the difference between the correct amount and the errors amount. The errors last month corrected this month is, there is in the beginning, you have to note on this error and you have to note how is it done. The overstatement of the credit, we have the beginning minus and then minus disbursement because it is overstated. Understated, it is under, you have to add in the beginning, but in the receipts you have to minus. And then overstatement of credit memo, you have to in the beginning and you have to minus in the receipts. Understatement of credit, debit memos, you have minus to beginning and minus to disbursement. So errors last month not yet recorded this month, the same. So if you're going to observe the summary of the error, so when there are deductions at the beginning and it will affect the disbursement, whatever, if it is negative, then it will be disbursement will be negative. But if it is a receipts, then it would be positive and negative. But if they are far with each other, then whatever be the signs at the beginning will be the design in the disbursement. So again, so we have example here. So NSF check amounting to 3399 returned in February, and this was deposited in January. So at the beginning it is minus because over. Disbursement is also over, so you have to minus. The NSF check amounting to 8,009 deposited in February and returned in March. So you have, it is a receipts, so you have to minus it in the receipts and you have to minus in the books at the end, because NSF checks are debit memos, and debit memos are deducted. NSF check recorded as a deduction of cash receipts, so returned in January and recorded in February. So it would be a deduction because it is an increase. So overstatement, so you have to minus in the beginning, but you have to add it in the receipts because it's the receipts of the month. Return in February and recorded in February, so receipts is 500 and disbursed is again 500, so it's equal. And recorded disbursement of January recorded in February, so minus it at the beginning, minus in the disbursement. Unrecorded receipts of January corrected in February, you have to minus in the beginning and you have to minus in the receipts because it would be a receipts of the past month. Unrecorded disbursement of January but not yet corrected in February, so deduct it to the beginning and deduct it to the end because there is no correction, so you have to correct at the end at the beginning. Unrecorded receipts for not yet corrected in February, so the same, it's a receipt you have to add. The other one is disbursement, you have to minus. This one is the receipts you have to add. And recorded disbursement for the month of February 1/6. For disbursement, you are going to add, and for the ending, you have to minus because it is a disbursement. The unrecorded receipts for the month of February 1/8. So it's a receipts, you are going to add in the receipts, and you are going to add also in the ending. Proof post-dated or unreleased checks of the companies included outstanding checks for the month of February. So this is, it represent disbursement, now minus it, and you are going to add back to the ending balance. whose dated check from customer in February recorded as receipts in February. So, it is a check customer. So, you have to minus it as a receipts and then minus it in the current period or ending because it is post-dated. Cancellation of company's check recorded by deductions of cash disbursement. So, you have to add back and you have to minus in the ending balance. Check of the company issued in January was mutilated and returned by the payee. A replacement check was issued. Both checks were entered in the check register, but no entry was made to cancel the mutilated check 27. In addition, this should be included as part of outstanding checks in January. So, at the beginning and at the end, it is presented as added. Check issued in January and was included in the outstanding checks in January was recorded for 3,000, but when the bank statement was received in February, the correct amount is only 300. No correction was made in February. 300 should be included as outstanding checks in January. So you have to adjust the difference of 3,000 minus 300 is 2,007. It will be added to the beginning and into the end. The company issued a stop payment order to the bank in February for check issued in February, which was not received by the payee. A new check was written and recorded in the check registered in February. The old check was written off by the journal entry also in February by 3,002 as receipts and as disbursement 3,002 to equate or to equalize the statement. Adjusted balance method, books, February, and then books. So, customer checks, you have cleared in February and February no record for this NSF check. Sa beginning, you are going to minus. Sa receipts, you're going to add. Payments directly from the collection, receipts 1,000, and then it is paid, so there is also a disbursement increase. Erroneous bank credit made, so 3,100 for the receipts and 3,100 for the disbursement. Customer dishonored check are recorded as reduction of cash receipts because check dishonors are deposited in February and recorded as regular receipts in S24. So, in receipts, add minus, in disbursement is minus. NSF checks amounting to 2,000 returned this month, redeposited this month, so it is a reduction of receipts and disbursement. Note, this is the traditional treatment in this text. However, as the check received by the company was returned due to insufficiency of funds effectively, the company did not receive payment at all. Thus, the amount of returned check should be deducted from the book balance end and from the book receipts and added back to receivable, and these are still collected from the customer. Paid out in currency. According to Impress system, all cash collections received by the company should be deposited intact with the bank, and all disbursements should be made through the use of check, except for payment of small miscellaneous items. Therefore, the payment directly out of the collection is a violation of internal control. For purposes of accounting all receipts and disbursement during certain period, the following treatment should be presented in the proof of cash, stating from the unadjusted cash balance. So, unadjusted cash balance and then paid out of collection. Note that the presentation, the payment out of collection is assumed to have been deposited in the bank and a check was issued for payment. So, our textbook is Daryl Ju Asuncion, MBA CPA, Raymond Francis Scala, and the book is Auditing Assurance, Concepts and Application, Real Excellent Publishing 2021, Part 1 and Part 2. References are Balix, Peralta, and Balik, Financial Accounting, Volume 1 and 3, Wilhington and Penny, Principles of Auditing and Other Assurance Services, Milancius Vernon, Financial Reporting Theory and Practice, Volume 1 to 3, Financial Reporting Standard, including PFRS for SME and Philippine Standard of Auditing. So, thank you. And for this Module 2, get in touch with the activities that is given in your G-class, and you are going to submit it within a given period of time, and the next module will be developed for Module 3. These are the substantive tests for receivables and loans receivables.